Being successful in the markets is more difficult than being successful in competing in the Olympics.
You can dramatically reduce your risk without reducing your return.
By having those four quadrants, I achieve balance.
If inflation is higher than expected, you would want to own assets such as
Knowing how to diversify well is more important than almost anything. People don't understand this.
Is that an art that you can teach?
Oh yeah. I wrote about it there's what I call a section in this book, the holy grail of investing.
Can you give us that formula?
Yeah. If you have uncorrelated assets,
Yes.
and you easily can, because when the economic conditions shift, it shifts returns from one type of asset to another kind of asset. So when you have uncorrelated or low correlated assets, you can dramatically reduce your risk without reducing your return. So, I mean, just to give that as an example, the holy grail of investing, and you don't have to do it. It could be 5, it could be 10, it could be 15, but you will cut your risk in half, or if you get out at 10 or 15, you will cut it by 80% without reducing your returns.
So to use an example, let's assume you have, to make it simple, a return, something that has a 10% risk. We'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset, another return asset, return stream. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation? Or if it has on average has a 40% correlation or a 0% correlation? How would that change? Wanted to know that, right? So that's what this chart shows, right? And so, so imagine you have a 10% average return. You don't know which bet is going to be better. Has a 10% average return and a 10% risk. And you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%. And you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is you only need to do this simple thing. The simple thing is to find 15 or 20 good uncorrelated return streams, things that are probably going to make money, but you don't know, but they have a good probability of making money, and that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you could do is find the best investments. Okay? That's important, okay? But there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably Nobody's humanly capable in an efficient market probably to pick investments that are 5 times as good individually, but so that path. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. You know, like if I can get zero correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%, okay, as distinct from 40% with any one of us. So that's the power of portfolio construction and the power of diversification. What are the two most fundamental building blocks? Inflation and growth. They can go up or they can go down. The markets will always discount some picture of the future. Today we can look at market pricing and we could say, what's the picture of the future that it's discounting? So prices then change based on how the future actually transpires relative to that picture we're discounting. So none of those assets have a higher or lesser expected value relative to what's discounted in the market. It's just the surprises that cause those movements, those relative movements. And so by having those 4 quadrants and putting 25% of my risk in those quadrants, I achieve balance. The notion of balance is going to be better than not balance because diversification doesn't cost you anything. Diversification reduces your risk without reducing your return. If they're all roughly comparable, like it, and today you look at assets and you tell me whether one's going to be better asset than another. Okay, well, that's what we're all betting on, right? And so it's certainly not the case that one is, you don't know necessarily which is going to be better, but you do know that they will have offsetting effects so that diversification is a tremendous thing in improving your return to risk ratio. If you know that, achieve balance in those 4 quadrants. That's timeless and universal. So I took that, put those balance in those 4 quadrants, and then I ran it through time. I ran it through the Great Depression. I ran it through the Weimar Republic in Germany in 1923. I ran it through all those environments. I got to a point where I knew that I was going to have more money than would last for me, and that I had created a trust, and I wanted a timeless and universal way of being able to have a balanced portfolio that had a better return than cash. Cash is the worst returning asset classes, so that's why I went around and I created that balanced portfolio that way, and it's timeless and universal. So it doesn't really change much, right? I mean, that notion of the basics of what I'm describing have always been true.
It's more important to know how to diversify well than it is even know how to pick the best things. And one of the problems of the world is that everybody wants up. They want up in the stock market. They want up in the real estate market. They want up in the economy. And that and central banks can produce up, okay, by giving it this shot of money and credit. They can always produce that up, but that up over a period of time has a consequence. And that consequence is that there's a lot of debt, and that has to be paid back. That will be paid back in depreciated money. So you don't want to be in that position of like, if your portfolio is going down a lot in this, that's not good. To give you an idea, if you lose half your money, it takes 100% return to get back. You lose 50%, you need 100% to get back. There are people who are in some of these tech funds and they're down 70%. This can't be part of the game plan. Okay, that's not part of the game plan. So the issue of being able to reduce risk through diversification, which doesn't reduce return, and in my view, never put yourself in a position that you could lose more than 25%. In like your worst case situation, 25% in a game plan, can be acceptable. But if you go into that, and if you look at any single asset in buying power, there's no single asset in buying power that hasn't lost 75 or 80%. So you need diversification.
Think of it as going to betting on a sports team, or in other words, horse racing. Okay, so there's handicapping that's going on. So in order to be successful, you're betting against the consensus, and you have to be right. That's the game.
And you described your first trade when you were a teenager. Bought a stock, it tripled. You thought, hey, this is easy, but you convey very effectively that in fact it is extremely difficult, even though it seems so simple.
Being successful in the markets is more difficult than being successful in competing in the Olympics. Your odds are higher to be successful competing in the Olympics because you have more people trying to do it. You have more resources. We put hundreds of millions of dollars. We have at Bridgewater 1,500 people. We're now competing against other teams. And that's the kind of resources that are going into playing that particular game. So think about that in terms of handicapping it. It's not an easy thing to do. What you can do is achieve balance. You can to know how to hold a balanced portfolio and to receive something that is a return that's much better than cash, achieving balance is something that you can do. And I think that. But figure, if you're going to enter the game, since value added is a zero-sum game, you have to ask, who are you playing against? Who are you going to the poker game with? And do you want to do that?
And as you talk to people in the real world, is your sense that people understand what they're up against when they might buy a stock or try to time the market?
Institutional investors who are smart, by and large, understand that. The average man tends to be much more reactive. If you look at the purchases and sales that they make, when something goes up, they're more likely to buy it. They think, that's a good investment. They don't know how to measure that in terms of, is that a much more expensive investment that's more likely to go down? So that's why, you put ads in newspapers and they say, that's what had that return. That's what they're attracted to. So they tend to buy high and sell low. And so the average man should not be playing this game in that way. They should be playing the game, or humility. If you think that you're good at playing the game, just make sure that it's like going to the poker table or going to the racetrack. Do it with a little bit of money and watch it and get the best advice that you can to know that you're going to be able to take money out of the system rather than put it in.
There are basically two big influences on markets. The growth rate and the inflation rate.
This is true for any asset class, and it's true for all asset classes. There are two main things that drive it in terms of, that's inflation and growth. And if you tell me that inflation is going to be higher than expected and growth be higher than expected, I would know what to invest in, higher than discounted. And if you say it's lower, I'll know what to invest in. And most people here would.
Like if you know that growth is going to be faster than expected and inflation is going to be higher than expected, you know that bonds are going to go down, and vice versa. So the way I give that as an example, so the way I look at it is there are those two big influences, and then they can, so I have four environments, and each one of them can go up or down. So there are four quadrants that I think of: rising growth, falling growth, rising inflation, and falling inflation. And I want to have a portfolio that will be 25% of my risk in each one of those so that I don't have any bias. And so I pick the assets that are going to do well in each of those four quadrants, and I hold them in a balanced way. If growth, so there's these four quadrants: growth and inflation. If growth is less than expected and inflation's less than expected, you would like to own bonds. Okay. If it's higher than expected, you would not want to own bonds. Okay. If inflation is higher than expected, you would want to own assets such as commodities and gold and inflation index bonds. If growth is faster than expected, particularly if inflation is less than expected, you'd want to own stocks. So you get the idea.